Hello everyone, good morning, good afternoon, good evening, wherever you are. Thanks for taking time to join me for this first US webinar of 2018. As usual, there'll be a presentation from me. I'll talk you through some charts of both the current economy and where I think things are going. You can ask questions by typing them on the chat window on your screens, and I will answer them at the end. What I thought I would do today, and it's kind of the clues in the title of the webinar, the US in 2018, how might it all go right? Well, that's kind of not my base case. My base case is that actually we see some pretty consistent rate hikes from the Fed. I think they go 4 times this year, and then they probably keep hiking into early 19, primarily on the back of the tightening of the labor market, which I think will generate faster wage growth and some inflation pressure. But there is an alternative view of the world. It's worth thinking about the idea that what could happen instead is that we get faster productivity growth and a pickup in labor market participation, which prevents the unemployment rate from falling further, keeps unit labor costs down, and potentially allows the cycle to run for a good deal longer, with positive implications for asset prices. In my base case, the asset price story becomes rather more challenging. Anyway, let me just begin, I think, with kind of the base story, and then we can think about some of the alternative risks in both directions a bit later. So to the charts. So the fourth quarter growth was probably about 3%, maybe a little bit below, but the average for the last 3 quarters has been close to 3%. Year-over-year growth in the first chart you can see has been rising now since early 2016. That slowdown that you can see there in 2015, that was the oil hit, the enormous drop in capital spending in the oil business, and then the knock-on effects everywhere else. That's what did that. Pushed manufacturing briefly into a very mild recession, but it didn't transmit into the rest of the economy because it was mostly an oil story. Anyway, as you can see, it's reversed pretty comprehensively over the last few quarters. But more encouragingly, the business investment component, which was very weak, has picked up. Growth was down at 0 in mid-16, but it's picked up quite nicely. The last 3 quarters have been strong. I think the fourth quarter will be stronger again. We might even scrape a double-digit increase in business and equipment and intellectual property investment in Q4. This is a very nice rebalancing of the economy. We've been waiting for this for a long time, and it's key to the story, kind of the second scenario where productivity growth picks up. So we'll come back to that. What's happening? Well, certainly what was happening before the hurricanes was that we were seeing a real pickup in small business capex intentions. If you look at the chart 4 there, you'll see that small business capex plans are picking up really nicely in 16 and 17, and then the peak here is the hurricanes. And then we get a crunch, and we haven't seen any recovery since then. And this is kind of alarming me, because in all the other data, we've gone back up again. So I don't know why small businesses are still so miserable, but I need to keep an eye on this. We need to see some recovery in that NFIB capex intentions number over the next few months, because as you can see, take those lines away, it's been a pretty good indicator for some time of the overall strength of business investment. So I don't want to see that weakness there persisting any longer. That's the only real downside in the story at the moment. The actual orders numbers, as you can see there, core durable goods orders are way, way higher than you might think if you were just looking at the path of oil prices, which for the last few years have been the key determinant of capex orders. What that suggests is some significant autonomous strength outside the oil and energy sector, which has been the swing factor in capex for the last few years. So that's good news, but I really need to see that NFIB number recovering again, and I urge you to keep an eye on that. So, what else is going on? The inventory cycle is looking really very positive. I'm just going to move a bit closer to the mic because some people are apparently having some audio issues. The inventory cycle on chart 5 has picked up very, very strongly. It's just tracking business sales as it usually does. But look at the risk on chart 6. We're going to see an inventory drag actually in the fourth quarter because of autos. So huge jump in auto sales after the hurricanes, but a lot of that has been met by falling inventory. And falling inventory in the auto sector alone normally wouldn't be such a big deal, but because the rise in sales was so enormous, we are going to see a clear hit. And that's going to mean that inventories are going to be a drag on growth. But you've got to see this in the context of the trend, and the trend clearly is improving. Business sales are improving, inventories are improving. We've got hugely elevated numbers from the PMIs globally. The US, China, the Eurozone, everything is really very strong. So there's no reason to think that the inventory blip we're going to see in Q4 is anything other than an auto phenomenon. So I'm really pretty confident that this sort of core business cycle story is working out quite well. The problem from the Fed's perspective is it's generating this tightness in the labour market that they're really struggling with. On the consumer side, the consumer confidence numbers are just through the roof. You can see there that if the only thing that mattered was consumer confidence, we'd be looking at 5% growth in real spending. We're not seeing that. There's not enough cash flow to support 5% growth in real spending, but 3% or maybe even a bit more should be sustainable. I think the Atlanta Fed's GDP now estimate for the fourth quarter is 4%. So I'm not quite that bullish, but nonetheless, there's some pretty strong consumption numbers out there. I don't think it can go much faster because the saving rate is low, and I don't think it can fall a lot lower. But income growth is going to pick up, I suspect, and employment growth is still very strong. So the consumer side, the core business side, putting aside that inventory blip in Q4, all looks pretty solid to me. The chain store numbers are strong. Auto sales, you can see the hurricane hit, but look at the last 4 months. We've recovered the losses, and we're seeing some real strength in the auto component. Each one of those 4 months has been significantly stronger than the consensus. So the auto industry has persistently underestimated how strong sales would be after the hurricanes, and maybe that's why they've been caught short of inventory and have had to run it down so aggressively. But again, this is a short-term story. The big picture, I think, is really pretty favorable here. One of the downsides in the fourth quarter has been the trade numbers, which have been horrible. October and November, you can see them on the chart there, were much worse than anybody expected. Exports are rising. It's just that imports are rising significantly faster, which is a sign of strength in capital spending and probably a sign of strength in consumption and underlying inventory building as well. But in the short term, it is hurting these numbers, and trade is going to be a drag. But I don't think that's permanent. The dollar is very competitive. Global growth is strong. The ISM survey of export orders is very strong. The actual numbers are kind of undershooting, but the gap will close eventually, and we should see better trade numbers. So again, like the inventory side, it's a drag in Q4, but it's probably not the end of the world. Housing strengthening nicely. Some of this strength here in the last few months is a catch-up from the hurricanes. But if you look at further ahead, the trend in mortgage applications is rising, and that's going to push up home sales, not massively strongly, but nonetheless a solid rising trend through into the spring at least. We're also seeing some easing of mortgage lending standards, and with consumer finances improving, the labour market improving, that probably ought to be reflected in further gains in mortgage demand. So I'm actually looking for a rising trend in home sales through most of this year, even though mortgage rates are going to rise. I think that's inevitable, but I don't think they're going to rise far enough to take out the housing market. You've still got negative implied real mortgage rates. House prices are rising at about 6%, and so you're still making money on buying a home. And there's still a lot of pent-up demand out there. So I'm really reasonably optimistic about the housing market. There is a short-term question mark because of the weather in December, January, and we get some home sales numbers this week, which I think will be weaker than November. I would ignore that. I think that's a weather effect. And what matters really is the mortgage demand picture, which to me is pretty good. So how's this all playing out in the labour market? Well, the payroll numbers, chart 17, we had a soft number for December, but the two previous months were very strong. The trend is pretty solid. No reason at all to think that sub 150 reading for December is the new trend. If anything, if you look at the survey evidence on chart 18 there, I've read it already, the survey evidence is suggesting that labour demand is running at about 300,000 a month. Now, labour supply can't make 300,000 a month. There's just not enough people left to hire. But what it suggests to me is that if payroll growth is going to run at 150, which would be a very big shortfall compared to the surveys, it will be telling us about restrictions of labour supply rather than lack of demand. And that means more tightening in terms of wage pressure. And it also possibly suggests that we're going to see a pickup in the participation rate. And that's hugely important as part of the alternative scenario. It's important in this scenario as well. So what do we mean? Well, if you look at the level of the participation rate in the last few years, it's been essentially flat. There's been 3 or 4 attempts at running it back up again. And each time it happens, people get excited and they get their rulers out and they start extrapolating the last few months and come to some wonderful ideas about how participation finally is surging, and that's going to stop the unemployment rate falling, and the Fed doesn't have to raise rates. And it fixes a lot of problems. The problem is that each one of those run-ups in participation is then reversed. These data are extremely unreliable. In fact, sometimes changes in participation are not statistically significant over a year. So when I see people writing about a 0.1% change in the participation rate in a single month, really find something better to do. These numbers are not reliable. But the trend in participation tends to track the NFIB survey's measure of how hard it is for employers to fill jobs. So, chart 19, 2 kind of volatile series. The blue line is the NFIB jobs hard to fill number, and the black line is the rate of change of the participation rate, not the level, the rate of change. As you can see, the latest point is 0. The participation rate is unchanged compared to a year ago. But that year-over-year trend in both of those numbers is clearly heading upwards. What this suggests is that we could well see this year, we ought to see finally a pickup in participation, because firms just can't find how they're going to, can't find the people that they want. They need to pay more. One alternative to paying a lot more is to dragging people from outside the labour force back in. This is hugely important, because if we're going to see a pickup in productivity growth, because we're seeing faster capital spending, that doesn't ease the pressure on the labour market necessarily in terms of the unemployment rate. So let's think about this. If we're growing at 2% GDP and productivity growth is 1, and in round numbers, that is the story of the last 5 years, then the rate of growth of employment is going to be 1%, which is about 1.5 million a year. Now let's just say productivity growth picks up to 2%. Then nothing else changes. Well, in that case, GDP growth goes from 2 to 3. But because productivity growth is now 2%, we've still got a 1% shortfall. So we still need 1.5 million people a year. So that means that a pickup in productivity growth, which is not accompanied by a pickup in participation, is not going to stop the unemployment rate falling. It's just going to carry on declining in the way that it has been for the last few years. Now, if you look at the chart 20 below there, you'll see that just carrying on with the current trend, the unemployment rate ends up below 3.5% a year from now. And that's not assuming any acceleration in labour demand. But it's also not assuming any change in participation either. So what would be, in an ideal world, we get a pickup in participation, which would maybe more than offset the pickup in productivity, or just offset at least the pickup in growth and productivity. And so the unemployment rate then would flatten off rather than continuing to decline. But I have to stress, for this scenario to come through, it's both parts. You need to see stronger productivity growth, and you need to see the pickup in participation. But the grounds for expecting that pickup in participation are not unreasonable. I wouldn't say it's a nailed-on certainty. Certainly, if we look back at 2000, 2001, we didn't get the pickup in participation that was apparently promised by the surveys. And these data are noisy. But I can't rule it out. And if it happens, then the path of interest rates this year and next year is going to be different. Because even if we see in this scenario faster wage growth, unit labour cost growth will be constrained by the pickup in productivity, and the rate of decline of the unemployment rate will slow. This is not something which will emerge quickly in the data, because all of these data, productivity and participation, are hopelessly unreliable. And so I'm not suggesting that this is a story which is going to stop the Fed raising rates in March or even in June, but it is a story that could play out over the course of the next 18 months or so in a way which would be much more favorable to asset markets, all asset markets, fixed income as well as equities, and would mean that the Fed could be much less aggressive. It would mean that a pickup in wage growth wouldn't necessarily be a disaster for earnings because it would be offset by faster productivity growth and also faster top-line sales growth. So in this world where we finally get the long-awaited productivity rebound and the long-awaited participation rebound, we do end up in a much better place for rather longer. It doesn't mean that the cycle is abolished, but it does mean that the Fed will not have to push the economy into a downturn as soon as the kind of base case where participation just carries on going sideways and productivity picks up a little bit, but it doesn't really rocket. In that environment, we continue to run 200-month payroll growth, and unemployment does track down to 3.5% by the end of this year. From the Fed's perspective, that's an alarming place to be. The last time unemployment was 3.5% was 1969, and core inflation at that time was 6%. 5 years earlier, it was 1.5%. Now, the war in Vietnam, paying for the war in Vietnam, had an enormous impact on that. But nonetheless, from the Fed's perspective, nobody thinks a 3.5% unemployment rate is remotely sustainable. But maybe we're not going to get there. Just to have a quick look again at the productivity element of this story. So this chart 39 here that I'm highlighting shows the rate of growth of business equipment investment and non-farm productivity. Obviously, there's an enormous distortion in the middle of the chart from the crash. But before the crash and after the crash, and certainly for the last 4 or 5 years, productivity growth has been quite closely in line with the rate of growth of business investment. And we know business investment is picking up. We've got a lot of data for the fourth quarter now, so my forecast is on there. I'm reasonably confident in that. If equipment investment can continue to run at that Q4 pace, then the trend in productivity that's implied by that is 2%. For the last few years, we've been averaging more like 1% or less. So this really would be quite a remarkable improvement, and it would continue to keep a real lid on unit labor costs. And that's important because the Fed is very focused on unit labor costs as a driver of inflation. And there's a reason for that. So look at the chart 40 there below. You'll see that actually over the last couple of cycles, unit labor costs have been a pretty good indicator of core inflation. And one possible explanation for the downshift in core inflation over the spring and the summer of 2017 was that it was tracking the downshift in unit labor costs. I've got to say, I think there's some element of coincidence rather than causality here, because what actually was more important, I think, was a sudden downshift in a bunch of unrelated components of the core CPI from March onwards, including things like cell phone prices and physician services, which was regulatory. There's some technical issues in the rental numbers. And there was a big drop in airline fares because of competition from Norwegian across the Atlantic. I mean, none of these things can be pinned on domestic unit labor costs. But from the perspective of the Fed, there's no question that the rate of growth of unit labor costs is a key determinant of their view of inflation. And even though I think unit labor cost growth is popping back up a little bit, it's still quite low. If productivity growth is going to continue to strengthen, as the previous chart suggests, then those unit labor cost numbers can stay down even if wage growth picks up. And that's a very important distinction. So it's not the case that every pickup in hourly earnings is inflationary. You have to look at the productivity context at the same time. So again, in this sort of better scenario where we've got some stronger productivity growth and rising participation, even if wage growth picks up, it's not necessarily sort of a massive threat to the Fed that forces them to be very aggressive on rates. I do think that wage growth finally is going to pick up. I will forgive anyone who's skeptical of this because I've said this before. But this time I'm more convinced that than in the past that actually we're kind of on the verge of this picking up now. And I just want to try and highlight what's behind that view. So if we have a look at this chart here, 22, you'll see that the breach between the tightness of the labour market, the NFIB survey, and the wage numbers came in late 2013, which is when the Obamacare exchanges opened. And there's a point when core inflation was surprising massively to the downside in core of PC in particular. And it turns out that the downside, or surprises in core PCE inflation through the healthcare component, which is nearly 20% of the index, are very important in driving wage setting behavior. And so if you model wage growth using the NFIB and the hourly earnings numbers, and also include a term which just looks at inflation deviations compared to the previous trend, what we'll find is that inflation shocks in both directions also affect wage-setting behavior as well as the tightness of the labour market. And so the chart here, 23, just shows deviations in healthcare inflation with a 2-year lag. It takes a long time to work through, compared to the error in a wage model based on the NFIB survey. And as you can see, the downside surprises in the wage numbers in the last few years have been very closely correlated with the downside inflation surprises through the healthcare component. But the message now is changing, because that deviation from the long-term average is heading back towards zero. And that ought to start pulling wage growth up over the course of this year. So really this year is a really big test for the idea that the downside surprise in inflation from 12, 13, 14 has had a very long lingering effect on wage-setting behavior. Because this hasn't happened before, I can't point out the previous experience when the model's been spectacularly right, sort of counterintuitively, but I do think there's a reasonable chance that we're going to see that upturn in wage growth coming through now. Again, in my base scenario where we don't get productivity back to 2%, it stays more and more in the quarter, then the Fed is going to be much more alarmed by this pickup in wage growth than they would be if productivity growth was rebounding strongly to 2% and participation was picking up. So this really is kind of the dividing line between the two scenarios here, because in both scenarios I'm looking for strong headline GDP growth. I'm looking for wages growth to pick up in both scenarios. The unfavorable base effects in core inflation, which are going to push up core CPI and core PCE from March onwards, are the same in both scenarios. What's different is the impact on unit labour costs and the path of the unemployment rate if we get that pickup in participation and productivity. So the reason I sound sort of hesitant and talk about two scenarios rather than my usual approach is to tell you, this is what I think is going to happen, is that the uncertainty over the productivity and participation numbers is enormous. It's partly a data quality story, and it's also a story about behavior of businesses. We don't know how businesses behave in an economy that looks like this because it's never happened before. We've never had such a long period of very weak productivity growth. We've never had such a long period of very depressed participation. And we've never had such a big gap between what companies are saying is happening to wage behavior and what's actually recorded in the hard data. So, over time, I do think all of these things will mean revert, but timing is everything. And I can't be sure that it's going to happen this year or next year or the year after, or whether it's going to be stretched over the next 10 years. But what I can't rule out is the idea, because a lot of the modeling points in that direction, that actually 2018 is the year when a lot of things do begin to mean revert. And some of them mean revert in a way which is very favorable to the idea that the expansion can last for longer. Interest rates don't have to rise so far across the whole curve. And that what look like very stretched equity valuations can actually become even more stretched. And the margin pressure that you might expect from wage growth could well be offset by the productivity story. So this is to my mind, the story where everything is wonderful is at the moment, I give that maybe a 30% probability. So it's not something that I'm saying is wildly unlikely, but I'm equally not ready to make it my base case yet. To be clear, my base case is that the Fed hikes 4 times this year and continues to hike into 2019, and that we do get some inflation pressure through the labour market this year. On top of the base effects in core PCE, core CPI, the Fed can't afford to take the chance that actually things that things become just too tight in the labour market and they struggle mightily with an unemployment rate heading down towards 3.5%. But that's still the base case. But this better world, this alternative universe, is not a hyper low probability event. On the inflation side, just to make clear where these base effects come in, they really are pretty startling. We've got this this remarkable pop-up coming in March, just because of the unwinding of the downside shifts that we got from last year in things like, well, there it is, there's the cell phone price collapse, and there's the plunge in hotel room rates. That's reversed already. Physician services is an odd one. Not enough time to go into microscopic detail here, but I think we're seeing a repeat of what we saw last year when we saw a run of declines in prices. we're seeing some weakness this year. I think physicians are effectively absorbing increases in Medicare Part B premiums, which cover doctor services. They're absorbing them in an attempt to gain market share, and that's holding that component down. So previously, I was expecting this to mean revert back to 4%, but I think that's now actually quite unlikely. But that's a very small component of the core CPI. Upside risk elsewhere, clothing prices are running way, way lower than the PPI. And so I think a closing of that gap is quite likely and very noisy. Airline fares running way lower than fuel prices, that probably won't change. Again, this is the Norwegian effect. Just about a 25% more capacity on the North Atlantic route than a couple of years ago. But again, it's a very small component. Much more important is what happens to rents. You can see some downward pressure on the monthly owners equivalent rent numbers, again, spring of last year, summer of last year. That's now reversed. It was largely technicality. I think that the rent numbers continue to run at about 3.5 year over year. So yeah, this is not a disastrous inflation scenario by any stretch of the imagination, but the unwinding of the base effects from last year is going to make it look bad. And I'm pretty convinced that that a large part of the flattening of the Treasury curve in 2017 was due to this unexpected downshift in core inflation, which really nobody saw coming. I mean, if you go back to this point here in early 2017, the only question was whether your forecast was kind of flat or rising, and what actually happened was this unexpected plunge. So I think it did make a material difference to how people thought about the future of inflation, whether it was something permanent, and it made a difference to the way that the Fed behaved as well. Now, had inflation risen in the way that had been expected, I'm pretty sure they would have hiked rates 4 times last year rather than 3. Anyway, so I'm going to wrap up in a couple of minutes and just and open the floor up to questions. But again, just to repeat, my core story: decent growth this year. Approaching 3% for most of the year, slowing down under the weight of the rate increases in 2019, probably from the middle of the year onwards. I'm not expecting the economy to roll over. I don't buy this idea, which I'm still hearing, that the economy is incredibly sensitive to short rates and 2 or 3 more rate hikes and it's all just going to collapse in the heat. I'm not sure I buy that. Although unquestionably there's more corporate debt around than there has been than there was before the last cycle. If you look at debt service ratios in the corporate sector, they're still extremely low compared to levels which have triggered recessions in the past. So in order to get debt service ratios, even back to the 2007 level, the fund rate's going to have to rise quite a long way, and the lags are quite long, and they're probably longer than in previous cycles, because if we look at the maturity of corporate debt, both on C&I loans and corporate bonds, they've risen enormously. So here we are at the 708 crunch, and here we are today, and we've got much longer maturities of all the debt. So the rollover risk, the crystallization risk from the Fed action is going to take longer than normal. Meanwhile, in the household sector, the debt ratio has been pushed all the way back to the 2001 level. So I don't see this vulnerability to very modest rate hikes coming through very quickly. I think the economy is likely to surprise us with the extent of tightening that's required ultimately to generate the cyclical downturn, which the Fed, unfortunately, will have to bring about at some point. Now, again, in my base scenario, they kind of get extremely nervous about slowing the economy down by the end of 2018 because of the 3.5% unemployment rate. And in the more favorable scenario, it takes rather longer, and maybe we can push the end of the cycle out to 2020. But it is coming. Nothing lasts forever, unfortunately. The tax cuts will speed things along. In both scenarios, they generate stronger growth. I don't think it's going to be an enormous difference this year, but it is. It's probably going to add 3 or 4 tenths to growth. Need to see how it plays out, but a fair bit of it will be saved, certainly on the corporate side. But it would be astonishing if the fiscal easing on the scale of the plan that was passed in December didn't generate some uptick in growth. It will be very uneven, that's for sure, because of the shenanigans over the deductibility of state and local taxes in high tax states. So if you look at the where the incidence of the change in state and local deductions is going to be the most severe, every one of those states has 2 Democratic senators. I mean, this is kind of a fairly naked political act to to pay for the tax cuts by squeezing states which are never going to vote Republican. And well, we'll see how it plays out in the midterms, but certainly it's going to have a meaningful impact on real estate markets in high tax states and on consumer spending in high tax states as well, because it's going to be a meaningful hit to disposable incomes, which will be offset by net increases in disposable incomes in other states. So it's definitely a resource reallocation on geographic political grounds, which I would imagine, were the Democrats to come back to power, they do their very best to reverse at some point. But as of now, unquestionably, this is a hit to those high tax states. But let's not lose sight of the fact that there is a substantial net fiscal easing on the tax side. I'm expecting eventually there will be a net fiscal easing on the spending side as well. The core story here is that Democrats are willing to trade more non-defense spending in return for agreeing to raise defense spending, and Republicans, I think, will agree to more non-defense spending in order to raise defense spending. So there's a pretty clear bargain to be done there. Everything is complicated by the immigration situation, as we've seen over the last few days, and I just don't know how that's going to play out. But I do, as soon as February 8th, we could be back in a ridiculous shutdown scenario. But I do think that the ultimate outcome, however long it takes, is going to be increased public spending. I can't imagine that we won't get a deal at some point this year which raises both defense and non-defense spending. So we are looking at a really substantial fiscal easing. That makes the Fed very nervous, and this is one of the reasons why my base scenario is not the wonderful scenario where everything lasts for much longer, because we are really throwing gasoline on the economy that's really pretty hot already. Without the tax cuts, I'd be more inclined to believe the favourable scenario, but with net fiscal easing on this sort of scale, it makes it much more difficult. Anyway, what this does for the markets, we're now seeing the breakout of the upside in the Treasury market in terms of yields heading up towards 2 3/4 for the 10-year and 3% for the long bond. I do expect those levels to be breached fairly soon. Quite how it plays out in the shape of the curve depends on the path of the inflation numbers. Everybody can see through the math. It's very straightforward that core inflation is going to be significantly higher over the next few months because of the unwinding of the base effects. But whether that translates into an emergence of inflation fear and a steepening of the curve, with the market telling the Fed that they need to get a move on more quickly, that's a more difficult call. At the moment, I'm not seeing any sign that the sort of month-to-month trend in the core CPI numbers is picking up. I mean, it's mean reverted to where it was before the run of downside surprises, but it's not yet picking up. If that's the case, then the base effect would be by far the dominant story, and which everybody can see working through the numbers. And we'll then kind of see a parallel shift up in the curve rather than a sort of inflation fearing steepening. Looking at break-evens, they've now returned to exactly where they were. 10-year break-evens are exactly where they were now before the run of downside core inflation surprises started last March with the report published in April. So that has now washed through. The status quo ante is restored, but there could well be, if we do see wage growth pick up, and I think that's probably the key, maybe more than the core CPI numbers themselves, but a clear pickup in wage growth, I think, would certainly push those inflation fears into the markets and test the Fed's resolve. I'm assuming that Jay Powell's first press conference in March is going to sound quite a lot like Yellen. Certainly his last public speech in any detail on the economy could easily be given by Yellen. I'm not expecting any big changes there. And I think that the message he'll be getting from the staff, from the forecasts, will be that the falling unemployment rate requires sort of preemptive action even before the wage numbers pick up. The Fed can't afford to wait until that happens. So March, June set deck for this year, and then I think we see what happens. Okay, I will leave it at this point. I've had your attention for 40 minutes, which I think is long enough. Thank you for sticking with me. Very happy to take any questions that you might have on any of the things that I've raised, or if you want to ask questions on the things that I haven't raised, please feel free to do so. Realize that you can't blast through the whole world in 40 minutes. I'm not seeing any questions at the moment, so I'll just shut up for a minute and see if anyone comes through. So yeah, I have a question now. So when Treasury yields break the 3% area, do I see the equity market stalling due to stretch valuations on low risk premiums? Well, in the base scenario, that's certainly a much bigger risk. I don't think there's anything magical about 3% per se. I guess it depends on where investors then think it's going to go. If we reach 3% on a rising trend, and equity investors are getting out their rulers and saying it's going to be 3.25, 3.5 before you know it, that's a lot more threatening to valuations than approaching 3% yields and leveling off. Again, this depends substantially on the path of inflation at the time that it happens. So I don't think there's a kind of an automatic panic at 3%. I mean, but and it does depend on the way that markets fall in terms of expectations for margins and unit labor costs. So again, in the good scenario where the rise in yields is a corollary of faster growth and faster productivity growth and rising participation. So in other words, it's kind of a rising R* kind of story, rising neutral real rates. Then that won't be accompanied by a massive margin squeeze, because the productivity story will mean that companies can absorb a faster wage growth. That's a much better outcome and generates much longer legs for the equity story than the scenario where we get faster wage growth but productivity can't keep up. In that case, valuations are really problematic because they're very stretched, and then we do see, I think, a significant risk of a correction. But as I said, it depends on the trajectory of yields as they get to that 3% mark, and it also depends on which side of the macro story the market comes down on. Next question: do a handful of US corporations with massive cash balances distort the average corporate debt numbers, make it look better than it is, or is the distribution of debt normal? Well, from the flow of funds data, I can't answer that question because we don't get a breakdown by size. But certainly, just looking at those few businesses which have got gigantic cash piles and kind of adjusting for that, certainly if you're looking at the net position, yes, it certainly is flattered by the likes of Apple and Google and a few others. But the gross picture obviously doesn't include those cash piles, and obviously the data that I showed you earlier showing the lengthening maturity of bank loans and corporate bonds at the point of issuance, that's also a gross story as well. So that's unaffected by the netting off of the if you're looking at the balance sheets overall. So how do you read this as a conclusion? Well, clearly those enormous businesses in the tech sector are invulnerable, if you like, to rising interest rates. It's not going to kill them. But economic turning points in the US cycle are usually about the small business sector. And so for them, we don't have specific data on small business cash piles. That those numbers just don't exist. But we do have data on aggregate debts, and that position to me looks vulnerable. So the downturn will come not in Apple and Google and Facebook. The downturn will come in hundreds of thousands of teeny little companies who are the ones who are doing all the hiring at the moment, and they're the ones who did all the hiring in the last cycle as well. So when we're looking at the signs of stress, the place I'm going to be looking for is going to be in things like the NFIB survey and the jobless claims numbers, which capture the behavior of all businesses, irrespective of size. It will be a small business, medium-sized company downturn when it finally happens, and you'll see it in those survey numbers pretty quickly. Right now, no sign of distress at all. The NFIB is really pretty super optimistic. And a question about the dollar. So the dollar, this is very vexed. I mean, and I've been discussing the dollar with a few clients recently, and so the dollar and dollar euro in particular is way out of whack. If you look at one year overnight spreads, dollar euro should be at about 0.97, 0.98 instead of 122. So there's been an enormous split. The divergence began more or less overnight. So I don't really buy these structural arguments about the Chinese not buying treasuries anymore and Japan not buying treasuries anymore, or big structural shifts in US politics and economics. The break in the behavior of the dollar came in the middle of April last year, kind of out of the blue. Now, a couple of things happened at that point. First of all, that was the time when the US published the first of its enormous inflation downside surprises, which came out at the same time as a bunch of other terrible data as well. And I think that really caused the FX market to question the Fed and where the Fed would be going to a much greater degree than the rates market did. The second thing that happened was the French elections. The French elections, markets had been worrying about a Le Pen victory and France going fascist and pulling out the euro and really causing enormous structural problems for the euro itself. It didn't happen. Macron won very comfortably, and it prompted a flow back into Eurozone equities because the fear of a sort of an immediate existential threat evaporated. So a couple of really quite powerful stories, I think, have driven a wedge between spreads and the dollar, but we've now got to kind of absurd degrees, and it's not at all clear to me that this can continue to last. I think what's given it some extra dimension has been that the FX market is now much more convinced than the rates market in Europe that the ECB is going to be tightening sooner than they say. Now, I think that view is going to be questioned next week. I think Draghi's going to sound very dovish. He's very good at sounding very dovish, and he has to really, because the ECB's inflation model is extremely sensitive to the euro. So the strengthening of the euro is going to push down those core inflation numbers, and of course Draghi has said over and over again he wants to see a broad-based 2% core inflation rate in the eurozone, and we're nowhere near that, and we could be significantly further away from it on the projections anyway if the euro continues to rise. So I do think that this euro rally is going to run out of steam relatively soon, but I'm not willing to say it's going to happen immediately. I mean, looking at the very long term, 122 is about the middle of the range. It's the average since the monetary union started in '99. So on that metric, the euro does not look absurdly overvalued, but it does look absurdly overvalued compared to spreads. In order for one-year spreads to justify the current value of the euro, they need to rise by about 200 basis points, which is really enormous. So I do think we're kind of approaching the end of the bull run for the euro, but it's not to say that the dollar's going to strengthen massively anytime soon. Question: how does the aging demographics of the workforce impact the Fed's thinking on NERU? Well, the way that the demographics are captured in the data is that about half of the drop in the participation rate since the peak has been due to demographics and the retirement of the baby boomers. The other half of the drop in participation is unexplained, and that's the bit that perhaps ought to be expected to come back. If employers are going to start pulling people out of the pool of people who are currently outside the labour force. So the problem with this is that we've never had a situation like this before. So we can't say, look, the last time we had an enormous drop in participation, which is 50-50 demographics and explain, then the outcome was X, because there is no last time that looks anything like this. A lot of people have been talking about an imminent pickup in participation for the last 3 or 4 years, and it simply hasn't happened. So has it changed their thinking on NERU? Well, not directly. It's kind of, NERU is simply the unemployment rate which triggers faster inflation. It's certainly put an enormous question mark over whether you think the unemployment rate is a reliable measure. That's the way that it's impacted the numbers. But whether you're looking at employment ratios or unemployment headline or broad measures like U6, the message is kind of uniform now that wage growth should be picking up. And I think that a better explanation for the shortfall in wage growth is this unexpected inflation story. It's a feedback loop. It's a feedback loop back into the wage numbers from falling inflation. So inflation falls for some unexpected reason. In this case, it was downshift in healthcare inflation, which then feeds into wage setting behavior, which then holds inflation down. Now, this sounds like a virtuous circle, and it is until the unemployment rate gets to be so low that it overwhelms that virtuous circle from the inflation to wages, and we get an autonomous pressure on wages. And that, I think, is the risk at the moment. How do I see the repatriation of cash affecting the treasury market? Well, I've got to say this is something I don't have an enormously strong view on, because I just don't know how much of this cash is going to come home or where it's going to go when it does. I mean, the experience of the repatriation under Bush was that most of the money ultimately was spent on dividends and buybacks. And so some of it was presumably parked in the treasury market short term and it came back, but ultimately it was spent on other things. This time around, well, presumably the effect will be bigger, but I don't think it would be enough to overwhelm sort of a secular upward shift in expectations of both real yields, the longer term story, especially if productivity growth picks up, and the nominal, the inflation expectation components, if we do see a pickup in wage growth. So perhaps repatriation is a temporary support to the treasury market, but I don't think it overwhelms the fundamentals. Companies are going to be under enormous pressure to do something with this money when they bring it home. Shareholders aren't going to be happy just to see it sat on their balance sheets, held as in the form of liquid securities. They're going to want to see it spent. Following up on the dollar, your views on dollar against EM, particularly MSCI EM currency index. Well, I'm not going to answer this in great detail because EM is not really my thing. What I would say is that the stress on EM from rising US rates historically has been quite severe. The golden rule is that if you're an EM with political troubles or an EM with current account deficit or budget deficits, or heaven forbid both, then you're a lot more vulnerable to rising US rates than the alternative. We learned that very clearly in 97, 98, and we learned it again in 2015. So some of the better performing EMs are much less vulnerable, but generally EM is a pretty uncomfortable place to be when you've got a Fed that's raising rates faster than expected. And I do have that for this year. At the moment, Fed funds future is pricing about 60 bips for this year, I think, last time I looked. And the Fed's got 75 and I've got 100. So that does suggest that interest rate expectations in the US have to move to the upside by another 40 bips or so this year. Other things equal, it's hard to see that being positive for EM. But this, we're not going to see the sort of tightness that we've seen in the past in terms of scale. But that's not to say that EM can withstand it. Some EMs, if we're going to be in a rising commodity price environment for a while, then the likes of Brazil, Mexico, Colombia ought to do relatively well. Chile as well because of copper. But of course, Mexico's position is enormously complicated by NAFTA, and the risk that everything falls apart there. So there's different stories wherever you look. But again, broadly speaking, it's simply a question of looking at those EMs which are most vulnerable, and they are the current account deficits, the budget deficits, and the political situations, because money just goes home when the US is raising rates more quickly than expected. I think that's the last question. Let me just double check that. Yes, it is. So, okay, well, we've been on the line for nearly an hour now, so thank you very much for sticking with me. If there's anything that you would like to ask as a follow-up, please feel free to email me, Bloomberg me, send me a pigeon or whatever means of communication you like, and I'm happy to follow up with any of your questions. I realize I've had to dash through these kind of two scenarios very quickly, so if there's some bits of the argument that you want to follow up on in more detail, I'm very happy to do that. But in the meantime, I thank you all very much for listening, and enjoy the rest of your day. Thanks a lot.